Good morning and welcome to our question and answer session on the webinar for blockchain, cryptocurrency, and digital assets, a banking and regulatory perspective. For those of you who missed out on the main session, you can click on the link below and watch the full version. So we had a lot of questions asked on the day of the event, but unfortunately we weren't able to address most of them. So I have joining me Loretta Joseph, our main speaker for the event, and we're going to answer most of the questions today. Hello, Loretta.
Morning. Happy Monday, everybody.
Hello?
Yes, I'm here.
Okay, I hope you're doing great.
Yes, I'm very well, and I hope you all are as well for a Monday morning.
Yes. Okay, so if you're ready, I'll just move straight to question number 1. So it says here that, do you agree to the notion that neither Bitcoin nor fiat fully qualify to show all the 3 main features of money, which is medium of exchange, store of value, and unit of account?
I don't disagree with that, but I don't agree with it either. I mean, and so I believe that fiat currency is what we have today. Cash can be a store of value. It can be a medium of exchange and a unit of account. Bitcoin, in the same way, can be considered by people to be a store of value in the first sense. It's not really a payment system because, as I said, the network is very slow. It's very clunky because it was not built to be a payment system. It was built for its security protocol. So it takes 10 minutes for a transaction to get verified on the Bitcoin network. It's slow and clunky because it's so secure. So in the way that people are looking at a way it means payments, no, it doesn't really fit that. Does cash? I think it does. Digital cash certainly does, and in some payment systems. But I think there are some cryptocurrencies that do fulfill the role of being payment systems and a unit of account and a unit of payment. I think more will come up as the hype and the protocols get more developed. Bitcoin to me is just a store of value. I mean, I don't sell it. I just hold it, and I refer to it as digital gold because I would hold it the same way that I hold gold. So yes, some people will say that the cash is all free, fiat currency. Some people will tell you that Bitcoin is, but I think if you're using Bitcoin as a way of payments, it's very inefficient. And especially because it takes so long to verify, it's a very inefficient payment means.
Okay, so we'll move on to the next question, which says, why did the Facebook Libra token using blockchain network technology fail to be approved and used?
So first of all, the Libra announcement of Facebook's announcement of the Libra coin was not actually a blockchain. It's what we call a one Merkle tree. It's actually not a blockchain at all. It's controlled by a centralized database. So it's definitely not a blockchain. What they did is they saw what's the one use case that really works with cryptocurrency. It's Bitcoin, and so I think they wanted to show that that's the digitalization of money, and Facebook have a lot of users, 2.5 billion I think around the world. And the reason it was stopped was because regulators and central banks who weren't taking cryptocurrency particularly seriously at the time, when Facebook came out and said they were going to launch the Libra coin, it for the first time ever challenged central banks and it challenged sovereign states, to be honest. So a tech company the size of Facebook could effectively come up against the likes of China and the whole democratic world. So it wasn't a blockchain, but it caused a lot of people to stand to attention. And if we're going to be having tech companies that can be the size of countries and effectively issue a currency which can be used cross borders by all their users, and how was it going to be regulated? There was also problems about what the underlying basket that they were going to manage around the Libra coin was going to be. Nobody could tell me what that was. I read the white paper and the blue paper. It was put together by some amazing people in the space, but as I said, it wasn't a blockchain. It was a controlled cryptocurrency that Facebook was going to issue, and they were going to let all their partner tech companies allowed to issue it as well. So it got stopped by the regulators because it was too much of a regulatory burden, and it was going to challenge what we could call states.
Okay, so this one says, how do you get airdrop or tokens?
So airdrop is a means that people can give you tokens without paying for them. So a lot of the projects we've seen in blockchain have been giving out tokens to the network or the people using the network for free. So it's just a way of them putting tokens into your wallet. So you can airdrop, I think, off an iPhone. I don't know if you can do it on an Android, probably. So it's the ability for the creator of a token or the group of people that have created a token to give it to the general public.
Okay. The fifth question says, can you please speak about the upside of green cryptocurrencies for a financial institution? Additionally, how do green cryptocurrencies enable a financial institution to grow its brand equity as more green and sustainable?
So that's the question there. I'm thinking is actually more about tokens. Cryptocurrencies themselves won't be green, but I think what they're actually referring to is how can we have digital representation of things like green bonds attached to a token. So there's many projects actually going on at the moment. I actually sit on the board of a green electricity program that gives electricity out to underprivileged communities in Los Angeles. But we're working on that. So it's not actually a cryptocurrency, but it's the tokens and getting people to participate in the network. So if we can give them tokens for being green, they get rewarded. So it's an incentive model. Cryptocurrencies in what I think this question is asking wouldn't fulfill the role, but a token could. So there's also been a number of initiatives from the World Bank and banks being able to transfer green tokens or tokens that represent, say, a green bond or an underlying asset that has green elements of it. So to make people use the more, I think that's what that question is asking. A cryptocurrency in itself won't be green, but if you had a token or a stable coin, is what we call them, which would be an asset-backed coin, which would probably have the underlying of being like a green bond.
Okay, this one says, it read that only 21 million Bitcoins can be mined. Why? How will they make sure it will not go beyond the limit?
Because when the white paper was created by Satoshi Nakamoto, the people that created Bitcoin, they only minted 21 million. So as I said in my presentation, so it's effectively like a digital form of gold. We look at gold as being scarce, but the other part of the question is gold that scarce? What if we find gold on another planet? It won't be bought for its scarcity, but it's a scarcity. But with Bitcoin, there is only 21 million made. The algorithm and the way that they will be mined means that once 21 million are mined, it'll go to a licensing model to have the miners legitimize the network and to keep the integrity of it. So there is only 21 million. As I said, we've mined 18 million, and that will probably continue until I think 2035, 2040. Depends how the hype around Bitcoin continues, and we might mine them faster. But it looks like there's probably another 10 to 15 years before all the Bitcoins have been mined. But it's done through a very complicated mathematical system. And if you go back and read the Bitcoin white paper, as I said, which is on the internet, you just Google Bitcoin white paper, it'll show you that there is only 21 million. So it's very scarce in why people are buying it. I think they're holding it as a store of value because it has the same characteristics as gold. So I refer to it as digital gold.
Okay, thank you. The next question says, what sectors of financial services will benefit from blockchain technology?
So that's like how long is a piece of string? From the underlying technology, there are so many use cases. As I said, looking at ID, having people digitally ID'd, there's trade financing, there's KYC, AML being done faster and more efficiently. A lot of the back office processes can be done much more faster and efficiently. We can have securities issued now. There's tokens, there's security tokens. I've written regulation around that in Mauritius as far as trading goes. There is trade financing ways that we can use blockchain. So anything that actually has a registry function, will have an application for blockchain. But also, as I said, a lot of the processes and procedures we use in financial markets and financial services are very slow and they're not secure. So if we can be using a lot of the use cases are around that, making trading and settlement and clearing much more efficient and faster. As I said, we can issue bonds in real time now because of the blockchain. We can atomically swap assets. So there's, as I said, so there's clearing and settlement, there's atomic swapping of different assets in financial services, there's the ability to KYC clients and do your due diligence process much more quicker, effectively, and cost efficiently. So there's many applications, equities, crowdfunding, so digital crowdfunding, ICOs. So yeah, it's, as I said, the use cases and the pilots just go on and on and on.
Okay, do you know of any examples of banks, financial service institutions that are already using blockchain technology? If yes, what way?
So as I said to you, so an interesting use case, I talked about atomically swapping bonds. So when a Bitcoin is changed on the network, I give you a Bitcoin. So there's no one in between. It's just the asset is moved and transacted instantaneously. So there's many use cases now around trade financing. I think Commonwealth Bank of Australia did a pilot maybe 18 months ago to 12 months, and they're bringing it into inception now of trade financing things like commodities, almonds. They did a big trade finance block on almonds, atomically swapping assets. So the World Bank also worked with CBA. They've worked with a number of other banks around the world at being able to atomically swap a corporate bond or an interest rate bond. There is other use cases that banks are looking at. Some banks are actually issuing their own cryptocurrencies, like JP Morgan. I think one of the more interesting cases, if you look at what DVP is, so DVP means delivery versus payment. So I was a trader of bonds in the GFC. Now what happens? Lehman Brothers actually were taking hold of bonds before they paid for it, and there's a long process and time lag between when a bond is traded and when a bond is cleared and settled. Now, so that was effectively the beginning of the financial instability that we saw, because and why Lehman Brothers eventually went down, because they were taking hold of assets before they'd actually paid for them. So there was a big collapse in the financial system. So DVP is delivery versus payment, and that's been a big pain point for central banks and even banks dealing with each other over the time that we've had sort of the modern financial system. So blockchain really solves that problem, and I think that to me is one of the best use cases. If you can bring delivery versus payment to being instantaneous, you take out the post-trade processes of that, credit risk, default risk, counterparty risk. So all those risks that have been inherently coming after a trade has happened, we can now, with the blockchain technology, remove them. So that to me is is one of the best use cases, and central banks are looking at how they can do that with the banks that they're obviously the prudential regulator for.
Okay, so you mentioned, and it's claimed, that blockchain as a digital currency shares the characteristics of grains, gold, real assets, or commodities of value, except it is not a legal tender. Hence, what then happens if for some reason you cannot trade and the system crashes?
So blockchain is not the application, blockchain is the technology. I think this question is talking about Bitcoin. And so in how the network works at the moment, it's decentralized. So every computer that is part of the network can see all the trades on the ledger. We're all looking exactly the same, but nobody can change that ledger. Nobody can delete things off the ledger, because if that did happen, every single ledger would be seeing exactly the same point of corruption. What would happen if the internet went down? What would happen to financial markets as they exist today? If we lost internet control, things would fall over in the way that we trade and settle things. But the other point is Bitcoin is now doesn't need the internet. So a lot of there was a company called Blockstream who about 5 years ago, these were the people that created the Lightning Network, the protocol on top of the Bitcoin networks to make it faster and scalable. They've launched satellites into space. So effectively, to use the Bitcoin network, you actually don't need the internet. And to wipe out the network, the Bitcoin network, even if the internet goes down, you would have to have 7 James Bond events with every security agency around the world trying to knock out one particular group of nodes in the blockchain network, and that's mathematically impossible. So if the internet went down, you could still have the network on satellites, but if the whole internet goes down, you're going to lose the whole financial system, and we haven't seen that happen to date. But I would say my argument against that would be the Bitcoin network would survive. Financial systems as they stand today wouldn't survive. Oh, I think you're on mute. I can't hear you.
Is it better now?
Yeah, that's better.
Okay, so there's another question here that says, while with stockpile of grains or gold, you have something you can consume or turn into jewelry and preserve. And in the case of digital assets or digital currency, what do you really have?
So in exactly the same way as you have a tangible asset, gold, you have an intangible asset. So Bitcoin is what we call an intangible asset. Just because it's digital doesn't mean it doesn't exist. I know people really grapple with the fact that they like gold, they like cash because they can hold it and feel it. But as as we all become much more accustomed to trading digitally using our telephones, our cell phones, I argue that the millennials and the generations under that don't find an intangible asset particularly different from a tangible asset. So digital gold to me is what Bitcoin is, and it has the same characteristics because both come out of barter systems. I mean, that's all you look what money is. Money comes out of a barter system. As I said, we used to trade, grains, and then we trade shells. Some people traded coins, stones, and then we moved on to paper-backed money. Is that actually backed by anything? And Mr. Nixon got rid of gold-backed currency in 1973. So I would argue that a piece of paper, is not backed by anything except the fact that it's got a stamp on it, and the central bank will apparently honour that if you take it to them. So they're the lender of last resort. But once you have a Bitcoin, unless you lose your wallet, or which is quite possible, you have that in digital form. So it's how people are more comfortable with an intangible or a tangible asset. I would argue that the millennials and the generations below are very comfortable with an intangible asset, and they'd prefer to be having an intangible asset than something like gold, because gold in itself is very hard to do anything with other than wear it. What do you do? I mean, if you want to sell it, it's very liquid, it's hard, you've got to lug it around. So other than wearing it, I always say with gold, like, what's the point of it? But everybody thinks it's valuable. So anyone, if everybody sees a unit of value in anything, they'll buy it.
Okay. There's another question here that says, there have been divergent treatments of cryptocurrencies by regulators. In Nigeria, they have been banned from the financial services sector recently. Other central banks, on the other hand, are thinking of developing their own digital currencies. Will cryptocurrencies become mainstream eventually?
So there's 3 different points to that question. I'll unpack them one at a time. So the Nigerian central bank and the Indian central bank have been looking to bar public cryptocurrencies. I think what the issue is there, it's just a lack of understanding. It's very hard to ban technology, and I work very closely with Nigeria and the Financial Intelligence Unit and dealing with the AML CTF risks around cryptocurrency. Sensible regulation is better than banning. When you ban something like this cryptocurrency, because everybody uses the technology, you can't ban a technology. And my argument is that you'll just push this asset class back out into the shadows where it came from. And if we don't make it mainstream, then you're going to have 2 parallel economies. So so you do have the likes of the Nigerians and the Turkish central bank and India not liking the fact about a public cryptocurrency. But I think the issue for me is that it's an education piece. The central banks need to understand it's actually not money. As I said, it's not currency. It's a commodity. But because the Bitcoin and the cryptocurrency ecosystem started to call this thing cryptocurrency, and as I said, the initial coin offerings, the minute you put a word that the rest of the financial markets or the world associates with something, you start to create confusion. So that's why I'm very adamant that we all have harmonized definitions of what we're talking about, because a commodity is not under the mandate of the central bank. Commodities are looked after by the commodities regulator, or a security is looked after by the security regulator. But because we've got such a confusion around the definitions, it's all getting mixed up, and people are thinking they need to regulate things that they don't need to regulate. So to me, definitions are very, very important. The more harmonized we have definitions around the world, the easier this is going to be managed down the point. But as I said, and then you've got other banks, like the Bank of Kenya have said they're going to use Bitcoin as their as their reserve currency. And then you do have a lot of number of central banks like China, Mauritius is doing it. A lot of jurisdictions are looking about having their own central bank digital currency. So that's just a digital version of their fiat currency. Now, that's not a cryptocurrency. So this is the other thing. It's very important to me that we all start harmonizing our terms of reference, because it's getting very confusing. A central bank digital currency will effectively be the digitalization of that currency of that country. Now, that doesn't necessarily need to be done on a blockchain, and it doesn't necessarily need to happen on a blockchain. And do we really need central bank digital currencies in some instances? Probably not. But there are, each central bank has a need differently. So, in China, they're trying to launch a central bank digital currency because they want total control. Then you've got places like the East Caribbean Central Bank who are issuing a central bank currency because they won't have corresponding banks. So the bank will have to effectively bank its people. Now, these are very different styles and use cases. It's not one size fits all with the CBDC. And they're becoming very popular at the moment. When I first started to talk about them in 2016, no central bank wanted to talk about them, but now everybody's talking about them. So you are having different reactions from different countries. But I really think there's a lack of education between central banks about what we're talking about. There's a lack of education between the different regulators. There's a lack of education around AML, CTF problems, which so that's the biggest problem I see, is that we don't have an education that goes across all the regulators. Everybody's confusing terms, and it's becoming very convoluted and very complicated. But hopefully we can all sort of start to drill down and all start to use the same terminology for regulations, which makes this a lot easier.
So do you think private institutions can create crypto exchange platforms in Ghana, aside the central banks?
So an exchange platform, as I talked about in my talk, we're talking about digital asset marketplaces. As I said, the word exchange is a bit naughty, because when we think of an exchange, I think of a securities exchange or a NASDAQ or a CME or the stock exchanges in a country. Now, that exchange word is not what these digital asset marketplaces are. They're effectively, an exchange is a public-private partnership of a country. It's actually infrastructure. But again, the Bitcoin people were a bit naughty, and they called these cryptocurrencies exchanges, which gives out the understanding that they're regulated, that they're private-public partnerships. That's not the case. They are just matching engines for buyers and sellers. So these exchanges, these digital asset marketplaces, don't take any risk. So when you trade on a securities exchange or a regulated exchange, there's the process called novation, where the exchange takes the risk of the buyer and seller just for an instant. And I've worked in many exchanges around the world. I've traded on most of them, and I've actually built exchange infrastructure. So these things are not. Is there a way that the banks can work with them? Of course, because the other problem is we talk a lot about anti-money laundering, KYC requirements of cryptocurrencies. Now, it's not a truth that these things can just do whatever they want and they're not regulated. Because if you trade a cryptocurrency on one of these digital asset marketplaces or an exchange, you have to have a bank account attached to your account. Because how else are you going to move out your cryptocurrency back into fiat currency? You have Yes, so that's where banks can help, because, and I think there's been a problem, whereas banks haven't wanted to bank the cryptocurrency exchanges or the blockchain ecosystem because they've always cited that compliance was too difficult. There was AML/CTF risk. I would argue now that if you look at the Bitcoin market on the weekend hit $1 trillion market cap. It's over $1 trillion. So my argument is now, with the blockchain technology, if people are using Bitcoin for nefarious activities, they're going to get caught because it's a secure, immutable ledger, which we can track and trace in law enforcement, and we do it every day. So I think the business case of why banks don't want to bank this ecosystem is going to become too big an issue to be beaten by the compliance. So I think, yes, and I think banks, from the compliance part of it and the AML/CTF risk, they have to start looking at banking this ecosystem and working with exchanges to make sure that KYC is done, properly, compliance is done properly, because it's too big a market not to bank now.
Okay, so what are the potential guidelines from a regulatory perspective towards cryptocurrency?
So as I've written quite a lot of them around the world, I think you need to look at regulation in two buckets. So the big kahuna of regulations is the AML, the anti-money laundering, terrorism financing regulations that come out of the FATF. So that overrides most countries. If you upset the FATF and you get in the blacklist, that can destroy a country. So there's that regulation, AML/CTF, and under it, in what was happening with a lot of these cryptocurrency and projects and the ecosystem, they were breaching securities law. To be honest, people going out raising a whole lot of money and then ripping people off and scamming. So these things, I would argue, were securities. So you have two different types of regulation. I think with the AML/CTF, the regulations need to be able to cover off who's the beneficial owner of a cryptocurrency, who, and so is the KYC AML done? If there's a suspicious transaction of over $10,000 done on any exchange, they need to be reported to that reporting regulator. And then securities regulators look at how you protect consumers and investors from being ripped off. So I think both of them join together, but if you have the AML/CTF regulations from the Financial Intelligence Unit, or whoever the AML/CTF regulator is, monitoring transactions and making sure that the exchange is monitoring any transaction of over, say, $10,000, that's key. And then securities regulators saying, we need to know the beneficial owners and the companies and the owners of these companies, or the directors that are doing this in our jurisdictions. Because once you do both those things, you take out the risk, because if you have criminal and civil penalties against people doing the wrong thing, it's a very it's a very big disadvantage to them if they get caught. And people, so you have criminal liabilities of jail, and then you have security penalties of money. So you $10 million fines tend to put people off, or going to jail tends to put people off. So if you can manage to have all those regulations covered off and incumbent in all the regulators, then I think this takes out the risk and the scared view that we see around cryptocurrencies and their applications.
With the implementation of the virtual assets guidelines by FATF, does that make cryptocurrency and blockchain a potential medium of payment?
So the FATF's ruling on that was they came out with something called the travel rule. So if you're a bank, when you are sending money across to another bank across borders, you have to know the beneficial owner of your account and also the person that's sending it. So that's what we call the travel rule. The FATF have now said, so if people are sending virtual currencies or virtual assets from one account, one wallet to another, you have to know the beneficial owner of that account on both ends and the sending account. The exchanges are complying with that because that comes into law, I think, very soon, I think maybe in June. And that sort of mirrors what happens in the banking world. And so the exchanges will have to comply with that. So yes, I think not Bitcoin, but there will be other protocols and a number of these other cryptocurrencies that will become means of payment.
Okay, what are the advantages cryptocurrency has over traditional banking payments like wire transfers and trade finance?
So cryptocurrency, so the underlying technology has many advantages for actually applying to trade finance, cross-border payments, because I don't know if anyone's tried to do a cross-border payment, but they're very difficult and they can be very inefficient. They can take a very, very long time. So the technology can actually help in that as a use case without cryptocurrencies. But we're seeing, with the mainstream, adoption now of cryptocurrencies, which I will say is mainstream now because 6 months ago it wasn't. When the likes of Elon Musk are coming out and they're saying they're putting $1.5 billion into Bitcoin on their balance sheet, the likes of Circle are saying we're going to be holding this on our balance sheets for in our treasuries. So that to me means things are becoming mainstream when institutions are starting to adopt them. I think moving across borders, yes, there's huge advantages if we can do this, because it cuts out the processes and procedures, and the middlemen, can be up to 6 or 7 banks in a transaction. If you're sending money from Canada to Africa, the amount of banks in the middle of that can get long and long and long, and it depends on what the transaction is. So there's huge benefits, I think, for central banks and just for banking institutions to be able to send information, to each other more efficiently and more faster and securely. So this is the thing, the blockchain is so secure. Whereas if you're sending information now across the internet, it's not secure, or you're sending money on the internet. We all know that we have data breaches and security breaches all the time. So the technology itself can solve some of those inherent problems that we see in how we do all these things anyway.
Okay, with Tesla investing $1.5 billion in Bitcoin and the potential of Bitcoin's market cap surpassing that of gold in the coming years, how are the banks in Ghana and Africa looking to have a share of the cake?
So that's what I was saying in one of the last questions about how can banks become involved. As I said, when Elon Musk says that Tesla is going to be investing, it doesn't mean that it's going to take over, other forms of investing. It just means that it's now an asset class that is becoming too big not to notice or too big not to get involved in. And as I said before, with the banks, not banking this ecosystem or central banks saying the banks can't bank this ecosystem because the AML/CTF risks are too high, doesn't cut it now, because you are losing out on $1 trillion market cap. And some of the biggest unicorns in the world, after we saw the dot-com boom, dot-com bubble in 2002, we got Facebook, we got Google's, we got some of the biggest tech companies in the world. After I think what you saw of 2017-18, as the crypto people will refer to as the crypto winter, the companies that are coming out of the burning to the ground, if for a better word, of that industry are now becoming billion-dollar companies faster than we've ever seen companies become billion-dollar companies. So if you look at Binance, who's one of the biggest cryptocurrencies exchanges in the world, they raised, I think, about $320 million back in 2017-18. They became a unicorn in 6 months. $1 billion company, the fastest ever unicorn in history. And now you're seeing more of these blockchain companies and these crypto companies coming out of this and becoming billion-dollar valuations, in under a year. So you have to look at what you have in Ghana. I think we need to not stifle innovation. Regulation is very important, though, because we don't want people doing the wrong things. And you're also seeing in the ecosystem, a lot of the entrepreneurs that are building these businesses, they don't want to do the wrong thing, but they're tech kids. They don't understand about tax filing and business plans and all the things that you learn as an institution. They don't understand that. So there has to be a mechanism where we can make sure they're regulated, because these businesses are scaling all over the world. And regulation is very important, because you want pockets of regulation that is similar. Because if you're a company and you come from Ghana and you want to go into the US and you've got different regulations, or you go to another jurisdiction, like Panama, because it's got no regulations, your life cycle as a company is very small, because you can't then go and scale back into a mature market. So for me, as I said, regulation is very important, because these companies can go anywhere in the world. And, they can there's no reason why some of the ecosystem in Ghana and some of these companies won't be the next billion-dollar company. It doesn't have to be in the US anymore. So we have to not stifle the innovation. We have to encourage these entrepreneurs and these companies which they're building sensibly, because everybody wins. And the social and economic benefits of a country now, to be part of that and not let it just happen in the United States, are it's very important. So that's why, I spend so much time, looking at Africa and India, because they're the youngest populations in the world. You guys have some of the best entrepreneurs in the world. And why do they need to go to America? Why can't they just do it locally?
Yeah. Okay, so this question says, blockchain technology is providing an avenue for receiving remittances. How can commercial banks capitalize on this development?
So remittances, I think I talked about it in my webinar. Remittances is a very slow and clunky process. I mean, if you're sending $50,000, $60,000, in back to a country, your bottom line isn't been hurt. But if you're remitting, $100 or $200 to your family every month, and it's costing you somewhere between 8 and 20% to send that money back, that's a lot of money. So we know the inefficiencies and the cost problems that we have with the remittances. The technology itself, if we can instantly send assets across the world, and that's what Bitcoin's doing in a lot of the emerging world, is that people aren't having to pay the middleman costs. There's a lot of there's a lot of interest in that, and I think if banks can look at the technology to ensure that these these transactions are not taking too many days and they're not being too costly, and we're getting the money back to people faster and more efficiently, they will have use cases and they will have customers.
Okay, so are concerns of many central banks regarding cryptocurrency justified? One major concern appears to be that criminals and terrorists can use cryptocurrency to transfer money undetected by the authorities around the world for various purposes. Is this really the case?
No. Well, yeah, well, I'll answer that in two ways. So criminals are always going to do something that they think can go undetected. And technology always involves nefarious players and good people. Always try and use technologies for for good and bad. As I said, having worked now with a lot of law enforcement and the ecosystem, the misnomer that Bitcoin is untrackable and traceable is not right. It's not anonymous, and everybody seems to think it is. But if you look at the Bitcoin transactions that are being done illicitly, they're very small compared to what people are doing cash. A money launderer will use cash because you can't trace cash at all. But as I said, because Bitcoin is on an immutable, transparent, secure ledger, guess what? You can watch it move from the place it was made. So it's actually turning out to be the best law enforcement tool that we've ever seen. So I think a lot of the problems, and again goes back to an education point, if central banks don't understand that the technology can actually solve the AML CTF issues, or the regulators don't understand how the technology works, yes, so everybody needs to have the same level of education. And if terrorists are using it and nefarious actors, they're going to get caught.
Can you please speak about the upside of green cryptocurrencies for a financial institution? Additionally, how do green cryptocurrencies enable a financial institution to grow its brand equity as more green and sustainable?
So I think that is related to the other question we had back, where he was they're confused, I think, about a cryptocurrency and a token. So I think, again, I really love the idea of green bonds, like digital green bonds, because if you think about it, climate change and carbon credits, we can now have a digital representation of an equity or a corporate bond or whatever it may be. And yes, it's becoming, the corporate governance around being green and issuing green bonds is becoming prevalent. I mean, we've noticed in the last year, I think, with the way that the planet got a lot cleaner when we were all stuck in little rooms not flying all over the world, shows that we can really make an impact into our carbon footprint, and that companies have to be more green and have to be sustainable in the future. Otherwise, they're going to get penalised. So I think the tokenization of things like green bonds and green carbon credits is huge use case, but it's not a cryptocurrency. A cryptocurrency, in this sense, would be the commodity. It would be the token, and the underlying asset would be green of that token, not the cryptocurrency.
Okay, so some corporate organizations are afraid of the disruptive character of blockchain technology. their belief is that they will lose market share or become obsolete. What is the
So
advice for such organizations?
So again, educate, learn, and learn and learn. As I said, the internet came along and everybody was so concerned that, that they were going to become obsolete and then nobody would be going to banks. No, that didn't happen. But I do believe you change and morph into the situation you have now, or you will. You have to embrace technology. And as I said, I don't look at this technology as being disruptive, as people say. I really think it's enabling, because the use cases around having open distributed networks for the security, for cost efficiencies, for just time efficiencies, are so much greater than the negative things around it. So be aware, embrace technology, because banks didn't disappear when the internet came out. They just changed their business models. And you have to morph and change and grow, and not look at these things as destroying you. You go, all right, we need to change our business model, or we need to maybe work with this ecosystem, or some of these projects are great. Let's start doing stuff internally that puts us on a level of change, because the rate of change and pace of technology is becoming so fast. I mean, from when I looked at cryptocurrencies, since 2012, had you told me that we'd be sitting today where we were, I wouldn't have believed you. But I can't keep up with the technology changes, but we have to, because if we don't, we will become obsolete. Embrace change.
All right, so how expensive is it to implement a blockchain technology, and how will an organization's business process and technology be impacted?
So, about expensive a blockchain implementation is, it depends what the project is. But, if you want to go and start mining Bitcoin tomorrow, or you want to go and have a wallet, that doesn't cost much. I don't think pilots, are that expensive. I think everybody should look at what are the pain points in your business. Like, what is the most inefficient part of your business? And you say, all right, can blockchain work here, or is it not needed? So I think around, as I said, KYC, enhanced due diligence, there's huge use cases around digital IDing people for compliance reasons. There's massive savings. And my argument is now, it's like, is it worth it to see what your next cybersecurity hack's going to be like for the bank or the institution? How big is that going to be? Or can you afford to have another cybersecurity hack? So how much are you going to have for that? So I think you've got to flip that question on its head a bit and say, can you afford to not be investing in this technology?
Yeah, I agree with that. Okay, so our last question is the blockchain technology scalable, and can it be integrated with an organization's legacy systems?
So I mean, the misnomer about blockchain is that it's going to take out all databases. You don't want to put everything on a blockchain. Let's all be honest, especially if you're banks. And as I said, the only time you need a blockchain is when you have competitors and collaborators in a network that don't trust each other but need to share information. You will still have databases that need to feed into the blockchain. Using a blockchain for every use case that there's a database is very inefficient and very silly. As I said, you may just need a better encrypted database, but if you're going to be moving value safely between participants in the network, it's very timely, and it's a good thing to do. What was the second part of that question?
Okay, so the second part of the question spoke to whether the blockchain technology can be integrated with an organization's legacy system.
Yes. So there is that integration can be done. It's just a database talking to another database, but one's a centralized one and one's not centralized. So I don't think there's a problem with the integration. The problem is with the blockchain. You've got to be careful what you put on the blockchain, because once it goes on there, you can't take it off. It's immutable and secure. So you've got to be careful about the information that's going onto the blockchain. Is it scalable? As I said in my presentation, 5-6 years ago, these solutions, these protocols like Ethereum was not scalable like Bitcoin, but there's new protocol levels that are coming on top of these protocols being built by some fabulous developers around the world that are fast solving the scalability issues. What we call throughput, so the transactions per second per protocol, to move thousands of transactions like the Swift network does every day, you have to have a very large throughput. A lot of these protocols haven't had that throughput, but they are starting to solve those problems of scalability and interoperability, because one blockchain really needs to be able to talk to the other. And if the Bitcoin blockchain isn't talking to the Ethereum blockchain, that's problematic. So a lot of those problems have come out and they've really been addressed. So I think, from here until the next 5 years, the issues around scalability and interoperability are going to be less and less and less.
Okay, Loretta, thanks so much for joining us once again.
It was my pleasure. I hope that was informative, and I'm on LinkedIn, or people can ask me questions all the time. I'm only more than happy to help, because I have a hashtag that says we're all in this together, and
yes,
and collaboration is the new survival.
Exactly. So we're hoping to a webinar 2 very soon, so that we can talk a bit more.
We can talk about DeFi, decentralized finance. Oh goodness, wait till we get into that. Peer-to-peer banking.
Wow. All right, thank you so much. So for those of you joining us, don't forget to click on the button below to watch the full event also, and then our Q&A session as well. I hope you've addressed most of your questions. Thank you so much for joining us. Have a productive week. Bye.